So ladies and gentlemen, my name is Adam from Trade with Precision, and welcome to the Trading Fundamentals webinar series. The topic today is the bulls and the bears, simple candlestick analysis for market direction. I love this. This is one of my favorite topics because we get to talk about price action and we get to apply it in real time to what's going on in the markets right now. Okay, so what I'm going to do, you should be able to hear me, you should be able to see me. The sound should be good as well. Please, if you are watching through GoToWebinar, the best way to communicate with me is through the questions box. Any questions you have, I would love for this to be as interactive as possible. So any questions that you have, please just type them into the questions box and I will respond in real time as we go. I find that's probably the best. Okay, so to give you, while you read the disclaimer, I'm going to give you some background behind myself. My name is Adam. I'm based in the UK. I live in London. I'm on holiday in Cornwall on the coast, so sort of southeast coast of Dover, near the Dover Cliffs. And I'm here for the week. And it's been overcast most of the week. And so it's not really a summer. And we're in August, we're in September on Friday. It's a bit crazy. So I usually day trade in the mornings. I'm not doing it so much on holiday here. It's very relaxed. So if I see a setup while I'm at my computer, then I'll take it, but I'm not actively chasing it. I'm going to take you through my routine during today's session because it's relevant towards day trading and price action. So I'm going to take you through that. So basically, I day trade the UK Open for about 90 minutes, the US Open when it overlaps in the afternoon with the UK for about 90 minutes, give or take. And then I usually look at the daily chart at the end of the day. So I've been doing more of that while I'm on holiday. I'll take you through that as well. I manage my own stocks portfolio. So I also really want to have some time to look at a couple of charts. I want to look at NVIDIA, I want to look at Disney, there's a few of these I want to look at. I want to look at Tesla, what's going on there. There's a whole lot of stuff. So we can apply price action to real things. So on the agenda today, we're going to talk about an introduction to candlestick analysis, learning the basics of candlestick charts and their significance in analyzing market direction and sentiment. Talk about key candlestick patterns, head and shoulders, double bottoms, double tops, explore popular candlestick patterns and understand the implications for bullish and bearish market movements. Talk about trading strategies, gaining practical insights into using candlestick analysis to identify potential entry and exit points, setting stop loss levels, and develop a robust trading plan as we look live at the markets for any potential real-time opportunities. So it's really interesting. Your journey varies upon most individuals as a trader, and it can be, you could be 2 or 3 years before you achieve consistency. You could take 6 or 7 years. A lot of that, ironically, depends on the path you pick. How quickly you stabilize, how quickly you mature emotionally, all kinds of things actually. But I am of the belief, that if I took 10 people at random and ran them through the same program, then I think that their results would be consistent. So the thing is that everybody who's learning on their own are all learning through different programs, and so the markets and their journey is also different. Let's talk very quickly about stop loss orders. So we must use a stop loss order. The sole reason that a stop loss exists in this universe is to protect our existing capital, to protect the money we already have in our account. It's there to make sure the losses are as small as reasonably possible. It's there to protect the account against unexpected market moves, against statistical losses, which are unavoidable, and finally, to protect the capital against us. We are possibly the single biggest threat to our account. We are way more of a threat to our account than random market moves and statistical losses, for sure. We are the most dangerous thing. So it is there to protect it from abuse from us. We need to understand that. When we take profit, when we use profit orders or take profit orders, that exists in this universe to add to our account, to grow our account. So if you're sitting there thinking, well, the stop loss is there, I can also grow my account with it. Technically you can, but that's not really what the stop loss is for. Stop loss is there purely for protection. It's like a bulletproof vest, parachute, that's all it's there for, and respected as such. Therefore, we should always have a stop loss. With every manual trade we take, with every discretionary trade we take, we should do it. You'll sleep better. Even if you don't in the beginning, you'll sleep better. Think about it like this. At the start of your journey, are you going to make more mistakes or fewer mistakes than you will later on in your journey? Well, obviously you're going to make way more mistakes. You don't know what you're doing in your first 500 trades. You don't really know. Your first 100 trades, you don't have a clue. First 500 trades, you start to get a clue. So are your losses going to be proportionately, are you going to have more losses? Are there going to be bigger losses in your first few hundred trades? Sure, of course they are. So right off the bat, right off the gate, the very first thing we should do is reduce our risk per trade for our first 100 trades. Ironically, patience is a big thing here. So patience is probably a greater requirement than discipline. Or if anything, you need the discipline to be patient. But to be patient, to not try to speed up your process. You cannot shortcut your process. You have to find your first strategy, your first one that you believe, that you trust, that will make you money. And you have to master it. And while you're doing that, you have to learn to master your emotions and keep your risk under control and learn to take profit. Putting a stop loss in is just one thing that you have to do consistently to do the right thing. You also have to make sure you take profits consistently. There's 100 things you have to do right, 100 things you mustn't do wrong. You could do 100 things right and do one thing wrong, and you can change the outcome. So there's two sets of kind of rules and barriers that you have to maintain. You want to stick to your strategy. So you want to find a strategy. So today is the best time for me to introduce this. Right off the bat, one of the strategies, there are certain very, very simple things. Sort of trading success comes from, ladies and gentlemen, trading success and investing success comes from doing the simple things really well. Don't even take it from me. Go on YouTube, look at the Berkshire Hathaway annual meetings where Warren Buffett and his partner, his business partner, Charlie Munger, where they get asked these questions. Do you think it's worth it paying a fortune to go and study economics at a university, to go to these high-end things, to do these executive courses, to do an MBA? Do you think it's worth it? Unilaterally, they say, no, it's not worth it. They say, in their own words, you can go find it. They can teach you everything you need to know in a week because they have certain rules and they stick to those rules. And each rule makes sense. But we can't help ourselves. We think we need to sign up, register with this forum, and we need to follow Bloomberg, and we have to do all this stuff. And a lot of it is a waste of our time. For real. Today, we're going to talk about technical analysis. And technical analysis, there's this idea, people think, that technical analysis and fundamental analysis are two completely different beasts, and they're not. They are two sides of the same coin. It's the same information. It's the same data. We're just looking at one in a text format, text, maybe graphs or charts, and technical analysis, which is also charts or graphs. It's the same thing, same information being looked at from two different perspectives. So, all right. So you want to find a strategy, and doing simple things really well is the key to getting on the path sooner. It's a bit of a tortoise and the hare scenario. So most people are familiar with the tortoise and the hare. It's an old fable. It talks about how the tortoise is slow and steady and actually wins the race. The hare thinks he's really smart, takes a nap because he's so fast, and he wakes up too late. And that's really the kind of thing that happens. You can't shortcut your destiny as a trader. Ironically, the fastest way to become a stable, consistently profitable trader is to start by finding one strategy, learning to master it, to understand it. In that process, your belief system will form. You'll realize you can do this. It isn't just that no one can make money doing this. It isn't just that maybe, well, some people can do it, but I can't do it. It'll be that everybody who ultimately picks a strategy, masters it, will ultimately become consistently profitable. So find your way, find your strategy, stick with it. Now, you're going, well, where do I find the strategy? Where do I do this? And as I said, it's doing the simple things really well. So we get all these traditional chart patterns. Most people have heard of them. You'll come across them in your earliest days. Head and shoulders patterns, double bottoms, double tops, inverse head and shoulders, cup and handle, triple bottoms, bear flag, bull flag, ascending triangle, descending triangle, pennants. All right, let's talk about this. It's the usual. So what we're going to do here can I get feedback from my team, please, that everything is looking good, that everything looks fine, if you don't mind? I know I've asked it already, but if you don't mind, if you can just double check this. Okay, so let's talk about the difference between trading and investing. All right, now, if you've heard me say this before, by the way, I apologize, but I'm going to try and keep it nice and quick, but it's important because when we do these types of events, usually 80% of the people attending are brand new and they haven't had the stuff, they haven't had it exposed to them, they need to hear it. And for the people who already know it, it's good to repeat it. So let's talk about this. So imagine we're looking at the daily chart for the S&P 500. So we see it going up, daily charts in an uptrend, goes into a downtrend, then it goes back into an uptrend, downtrend, then a little bit higher, and then eventually it sort of goes up. Okay. So let's talk about investing. So this is a generalization, but it's generally true. When we're investing, we have some spare cash. It's usually cash we don't need. It could be $1,000 bucks, $5,000 bucks, 50,000, 500,000, could be. We want to put it somewhere. So historically, there are different places we can invest money. We can invest it into property, we can invest it into stocks, we could invest it into cryptos, we could invest it into old bottles of wine. There's lots of different investment vehicle opportunities. Each one carries with it success rates and risk rates, I guess. So let's say in this case, we decide to put it into the S&P 500 index. So normally the next thing that happens is it's burning a hole in our pocket. We just want to get it in. Our logic is always that the sooner it's in the market, the sooner it can start to work for us. So if somebody said to us, well, listen, the market's a bit overbought at the moment, I recommend that you wait a few months before you put the money into the market. Most people would just forget about it. I'll put the money in now because the sooner it's in the market, the sooner it's going to work for me. So they wouldn't worry about their exact entry price. I've never met anyone who was worried about the exact entry price they had. As a retail, we are what you would call a retail investor, retail trader. And our market share has grown from 10 years ago, well, actually from 2008, 15 years ago, it has grown from 5% of the market. We are now pushing between 20 and 30%, depending on which market you look at. So it's grown, it's very good, it's a good thing. So then they're in the market, they then have to write out the good times, write out the bad times, write out the good times, write out the bad times, excuse me, write out the good times, and so on. But the idea is that on a long enough timeline, the market's going to go up. So this is interesting because what it immediately does is it immediately eliminates certain markets. If they need the market to go up, in other words, if it has to go up in value, that eliminates markets that might go up or down. It eliminates currencies because currencies are made up of two economies. It's made up of the US economy, supply and demand, versus the European or GBP economy, supply and demand. So it's a lot more complicated. There's multiple cogs there. So it eliminates currencies. It potentially eliminates certain commodities that have seasonal impacts. So it eliminates certain things because what you really needed to do is to bake. You needed to just put the money in, leave it to cook and bake and stew and marinate so that it can just grow up in value. You need to go up. So that eliminates certain markets immediately. It's a time-based thing that over time the risk should be reducing and the profits or the value should be increasing. So that's interesting. So immediately, no fixed potential entry price, leave it to cook, write out the good and the bad, and hopefully over a long enough period of time, it'll go up. And also, if you don't need the money, you won't take it out. So they might not even necessarily have an exit plan. Let's move across and have a look at trading. So trading is very different. Trading is when you must earn a primary or secondary source of income every month. You're trying to supplement your income or you're trying to replace your income with trading every single month. In order to withdraw money from your trading account to pay yourself, to pay your bills, you must have closed out trades. This is crucial. This is immediately a very big difference between investing and trading. You must have closed out those trades. You must have banked the cash. You must have banked the money. And in order to do that, your opportunity ideally must ripen ideally within that week or within that month, which means traders are actually looking for opportunities that will only last a few hours to a few days. So again, completely different from investing. So then what happens is you're looking, you see it's an uptrend, you see a very nice bullish candle. You get in, your entry is precisely 1 pip above the high of that candle or the spread. Your stop loss is, for example, precisely 1 stop below the low of that candle, and you take profit at 3 to 1. So it's very different. Fixed rule. If the market's going up, you're buying, you're looking for a specific entry, specific stop loss, specific take profit rules that you do not deviate from. Because now it's a numbers game. Because while somebody might have 10 stocks in their investment portfolio over 10 years, you will be taking 10 trades in a month that will all close out. So in other words, you will very quickly within a month find out what your win-loss ratio is on each trade you've taken. You will, it's unavoidable. When the market goes down, you'll potentially see a nice little bearish candle here with a nice little wick to the upside. Entry is exactly 1 pip below the low, stop loss exactly 1 pip above the high, taking profit at 3 to 1. Take the trade. Very specific exit. So compared to that, with trading, you have a very specific entry, you have a very specific, you can trade up or down, so it doesn't really matter the direction, and you have a very specific exit point. You will and you have to and you absolutely must exit those trades. I tell you this because traders get in on a trade and then switch it to an investment. They go, I think in a long enough period, it'll come back in my favor. So they start introducing bad ideas, bad habits into trading, which don't belong in trading. So if you think of trading and investing being played in the same arena, it's similar to football and rugby, soccer and football and rugby being played on a big green field with a ball, with goals, with a similar number of players on each side. Largely, they are, broad strokes. They appear similar at first glance. They're not. They're two different games. You can't mix up the rules. Okay, so you need to understand, ladies and gentlemen, when you sit down, you need to know what it is you're doing. What's your purpose? What's your goal? How you're going to achieve that? And today we're going to be focusing largely on trading, but price action is universal to carry on across. Okay, so these are absolutely just so crucial, the differences between the two. All right, so let's go back and let's talk about a few other things here. Let's clear this. It's very important to get that. There's only two market conditions that exist on any market, any time frame. One is where the market has no clear direction. It's mixing up its highs and lows. That's important as a characteristic. So it's not trending or it's trending. It's either trending up or trending down. That's it. Any market, any time frame can only be existing in one of these two states at any one time. This is crucial. The next thing that happens is there's, let's pick a different color here. There's really, for most retail traders, there's only 3 ways you could trade the market. So let's start with number 2. This is a valid way to trade the market. It's possible for retail traders and investors. And understand that when we talk about the bigger institutions, the mutual funds, the big banks potentially, as well as say hedge funds and so on and so forth. So big institutions. In amongst this, you will have some technical traders. You will have some that are trading similar strategies, but also a lot of them are trading such large amounts of money that they are looking for different kinds of opportunities and different time frames and different markets. Retail traders are very lucky. You might not think so, but we are. We operate in a very, very liquid environment. Usually our accounts are under $1 million or under $5 million for the most part. And that allows us, especially if we're trading on margin, it allows us to trade into a lot of markets where we're not even moving the market. Whereas most of those guys have a problem. Anything they do could potentially move the market. They have to trade against each other. So big fish will trade against big fish. Okay, so how do we engage on this? The second best way to do this is identify a range, identify roughly the top and bottom of the range, look to sell from the top of the range, try to take profit just ahead of the inside of the range, put our stop loss outside of that range. Okay, stop loss outside the range, taking profit just inside the range. Potentially, we could also buy at the bottom, trade it up to the top, take some profit just inside that, stop loss outside the range, So you can trade it top to bottom. It's okay. It's not a bad way. It's technically a way to engage in the markets. When we get to price action, all of this is important because the way the markets move. All right, the most important, absolute most important thing on any chart is going to be price. We'll talk about that in a moment. So we can trade this top to bottom, up or down. You can get some nice reward to risk. You've got lower volumes because there's not as many people engaging in a sideways market. They're not really very happy with it. And there's no clear winner. There's both buyers and sellers in there. So you could sell here and make money or lose money. You could buy here, make money or lose money. It's a little bit, the probabilities are a bit mixed. The third way, which is a terrible way, in my personal opinion, very biased, but also very experienced, is reversion to the mean. So reversion to the mean, the idea is that you would sell back to what you would determine as the average. You'd risk 1% for usually a smaller amount, which is 0.5%. On paper, it sounds very clever. Lots of people who are especially conservative people think this is a genius way to engage in the markets. Problem is you're trading against the flow of the markets, you're risking, your reward is less than your risk, and you have a high number of losses. So it's very demoralizing emotionally. You counter when someone says, well, holy cow, I saw Tesla break out. You're like, wow, it's amazing. No, I was shorting it. I was going the other way. So it makes people do a lot of really stupid things thinking it's a really good idea because on paper it sounds great. Terrible in reality. The number one best way to engage in the markets for retail traders is to trade with the trend. So once we know which way we want to go, the next question then just becomes, where do I get in and where do I get out? Where do I get in, where do I get out? Which leads me to my next point, which is any entry into a position in the market, any entry is either on a pullback or a breakout. That means that if we detect a new low, here, as soon as it breaks below that, that's one potential entry in. Otherwise, we wait for a pullback, whereas price starts to retrace, we're looking for an entry on a pullback. That's it. So any retail strategy traditionally is looking for an entry or a pullback. That's it. Okay, so we generally are looking for that. For example, here, we're looking for a potential change of direction, which would usually actually make it a type of breakout, stop loss on the other side, target it this way. Or a change in trend, we'd usually, again, be looking for a breakout or a pullback, any kind of thing there. Same thing here, we're usually looking for that kind of reversal. So, which then, again, let's go to this. The nice thing about it is you're trading with the flow and your potential profits on those trades are usually way bigger than your risk. So it's usually a nice positive reward to risk trade setup. The next thing that happens is, and I want to do this on an actual chart. So I'll talk about price levels, keeping a clean chart, then we'll talk about price action and how price action responds to that. And actually, because I've just told you that you can only have two types of market conditions. You have sideways markets, which is undecided, indecisive, or you have bullish, you have an uptrend or you have a downtrend. You really can only have two types or three types of candlesticks. You have indecision candlesticks, you have bullish candlesticks. Every candlestick can either be bullish or bearish. It will fit into one of these three categories. So this is beautiful. I want you to oversimplify stuff. I want you to think, we want to think big picture as well as detail within the big picture. That's what we tend to do. Okay, right, so I think that being said, let's move across to the charts. Let me just check how many of these are as well. That's good, live market analysis, and we'll come back to this as well. And so let's go across to the platform and let's talk about gold. Let's go to gold. Let's start with a different one. Let's go with a new one here. Let's use gold. And let's just see what we've got if we just go with a plain one. I forget which one mine is. Okay, that's fine. We'll just go with support resistance level. So when we look at the monthly, all right, for gold, we look at this historic thing. And I'm going to remove all the objects here. So let's just go through and clean this up. So there's a very nice script that I can use for this one. Go through to my scripts and just clean up all the objects here. So it just removes all the drawings and stuff on the chart. Okay, so when, oh, and actually I'm going to get rid of this indicator as well. So let's get rid of that one. All right, there we go. So what if you said to me, Adam, because now we're going to build from the ground up. We're going to go, okay, you don't need to overcomplicate it. You don't need death by 1,000 indicators. That's ridiculous. You don't need to overthink it. Okay, ask yourself, am I trading with the market? Is it a sideways market? Am I trading against it? Always check whether that's going to be the case. And so because there's different people getting in on different time frames, there's day traders getting in on the 1 minute, 5 minute, 15 minutes. There's other traders getting on the 1 hour, the 4 hour. There's big investors getting in on the daily, weekly, and monthly. There's just people getting in and out of multiple time frames. And even if, for example, you have a property market, so let's say you own your home, you want to sell it, and the market is good. So in other words, it's a seller's market because there's lots of people looking to buy properties. In that market, there's going to be people looking to buy a house because it's a buyer's market. They want to move. And there's going to be people who want to sell their house during that. So in other words, even if you have a bull market, you have people selling. You have people taking profits. And in a bear market, you have people buying, investors and longer terms, statistical traders and will tend to be, and technical traders will be looking for buying opportunities. And there's also sellers. So in any market, whether it's a bull market or a bear market, in case you've ever thought, well, why would there ever be sellers when a market's going up? There's always someone selling when the market's going up. They have their own reasons. Usually they want to get out of a position Maybe they've gone short. There's a lot of people that think the market's going to crash and they're shorting the market. So the most important thing when we start on looking at price is price levels. Okay, what does that mean? It means that if we are looking at a market, if you go back to before computers existed, people were still looking at a ticker tape and they were looking at the price of a stock, and it would go to $50 and then $52 and then $55. And they would notice that certain prices became significant for that particular instrument. So gold would be down at $250. And then when it got to $260, it couldn't go any further. And then it'd come back down to $255, and then eventually would go back up to $260, and then it would break through $260 and go to $265, for example. So price would sort of battle, couldn't get through, then it would break through, then come back and test it. And they observed all these things without seeing it visually. They would just see it on, what I mean is they wouldn't see it on a chart, they would see it, the numbers do that. So the way the markets really tend to work, they tend to break through key significant levels that fall. All right? And we identify these levels. So every time we introduce a chart, what we're really looking to do is to see with this particular instrument which levels are significant. And so if we take gold as an example and we go ahead and we just start putting in levels. So let's just say I go to 1600. So there's 1600. I'm just going to put a few of these on. So we go to 1600, and then I'm just going to go to 1700. 1800. I'm just going to go start with round numbers because round numbers is psychological. That's kind of what we do. Then go through to 1900, 2000, and so on. 2000, there's 2000 and 2100, give or take. So you can see generally, you can see that the market is responding to these levels generally. It's a loose round number, but you can see the market responds to that. Now, part of the reason sometimes the market gets close to but doesn't respond to it is anticipation. People who are buying up to 100 or up to, in this case, 1800, want to make sure that the market, they get their profit ahead of that. So they'll get out at 1795 or 1797. I do this. And so sometimes the market can stall just ahead of a major level because everybody else has actually anticipated it's going to go there, and they've exited, they're extricating their orders, their positions, and taking profit ahead of that level. So it stalls just below the level. Sometimes it goes just above, sometimes it doesn't, but this is the case. This is what happens. So horizontal levels and price levels actually are the first thing on any given chart that are significant. Then we start to look at price action. So what does that mean? It means that we start to watch how does price react when it gets to a particular price level. That tells me something. If price has a reaction like this, if these wicks form at a particular level, it tells me a lot about that. Okay? It tells me a lot about the market's reaction, as though it's touched something hot and it's burnt itself. And the second time, we can see what's going to happen. And the third time, we can see what's going to happen. So it tells me a lot about what's going to happen at that. So actually, when we're trading price action, what we're doing is, first thing we're doing is identifying key levels. And then, ladies and gentlemen, we're observing how price reacts to that. And if price reacts bearishly, we might then get prepared to take a short position. So remember, if you just go back, I want to recap here. Trades are shorter term opportunities. What is the market? Think about this. It's looking at price action, and price action is communicating to you. Remember this, that price action is what forms with physical orders going in. These are orders that are actually received and placed in the markets, not a Goldman Sachs article or somebody on Bloomberg saying George Soros is doing this, Warren Buffett is doing this. These are, forget about what you hear. This is actual orders going into the market, being placed. So the beauty of it is price action is the result of physical orders coming in. And what it does is, we don't live in a world where the market is constantly changing its mind every second on every time frame in every direction. That's garbage. That's not how it works. For the most part, the people with the most money who know what they're doing are looking to identify very high probability opportunities. Not only that, we're creatures of habit. We tend to avoid what lost us money yesterday and repeat what made us money yesterday. And when you put us together, when you put us in a crowded room, which is in a market together, we follow the crowd. We tend to, instinctively, we tend to follow that. So what I'm saying here is that when someone says the market is pure randomness, it's not. They don't even understand quantum mechanics. They don't understand how the universe actually works. Within the chaos, there's always patterns. There's always within a crowd, there's always the desire, survival desire to follow the crowd to do stuff. And so what I mean by that is, even if you try to make the markets random, patterns are going to form. People are going to do what other people are doing. We're just going to follow that, especially the experienced people. You're going to watch what's the market communicating. I'm telling you this because what actually happens is the probability when the market says to you, I'm bullish, if I break through this level, I'm going to go to the next price level. When it tells you that, it's being honest. It might fail, but it can tell you that's what I want. So if you think that somehow you're being manipulated and the market's producing a bullish signal and it's going to change its mind, statistically, it doesn't work that way. This is why head and shoulders, I was saying to you about strategies. Head and shoulder patterns have an 83.04% success rate. Look it up yourself, look it up. Meaning that they tend to unfold. When that pattern is setting up, it tends to unfold, and it has an 83 win ratio. Okay, 83 out of 100 trades should make money. Double bottoms make money. Bull flags, bear flags, they make money. But people ignore them. They go, oh, it's too easy. It's too easy. And that's the thing. It's the same thing. If somebody said, well, you know, I wish I could have a good body. There's a lot of people out there that can give you a routine that'll make pretty much everybody's body look good. And they could throw it out. They could throw it out on flyers on the street. And people would just dismiss it because they would just, it's too easy, it's too accessible, it doesn't make sense. So if I had a really good strategy and I was handing it out to people, people would just not try it, or they wouldn't take it seriously. So my point here is that it isn't necessary at all about the success about the strategy. It's the application of it, it's the making sure you master it and understand it. And so people don't think a head and shoulder strategy is sexy, but it works. It is there, it works. Okay, as an example, so here we go. Here's a beautiful level. Look at this really nice level here, 1300, very cool. Let's go through there. Got a couple of these things, beautiful breakout candle. These are very significant, these little candles that break through price. Whenever there's a consolidation, we have what we call a momentum candle. It's a little thing. Over here, we've got a little bit of a consolidation of candles. Nothing really moves here because we get the momentum candle. Takes us out of that consolidation. Over here, we've got a beautiful little consolidation of candles, not going anywhere, and we get the momentum candle that breaks out. Is this also a momentum candle? Sure, you can say that. Again, a little bit of a consolidation here, guys, and a momentum candle that takes us out. So over here as well, consolidation, they're everywhere, and a momentum candle. Excuse me, itchy throat. So we get these beautiful things that happen. And so they just repeat. The market just repeats. It's not hugely complicated. It's about 100 things that happen over and over again. Probably not even. One day I'll probably try and create the exact list, and I can say to you, it's exactly 45 things that happen over and over again. But for now, it's not an infinite number of things. So once you understand that, once you accept, it's actually even about accepting it. I can tell you the way the market's going to go. You have to believe me when I say that. So here we go. Good. Look at this little consolidation of things that don't go anywhere. Then you get your momentum candle out. Okay. This is what I call a pause and go. You get a move to the upside. You get a candle that doesn't really go anywhere. Then you get the next candle, and then it kind of takes off. And they're not very big moves. It goes there and doesn't move. So the market does the most moves are the 1-to-1s, meaning this move is equal to that move. The market does far fewer 2-to-1s and even fewer 3-to-1s. 3-to-1 is the generally accepted biggest move that the market will do on average. So in other words, I don't know the exact stats, but something like 95% of all moves will be between 3-to-1s and 1-to-1s. All the others, 4-to-1s, 5-to-1s, and so on, will fit within the 5%. In fact, it's probably different. It's probably 98% of all moves will be under 3-to-1s, and then it's everything else will be in the last 2%. So it means that if we want to take an approach to the market, trade with the trend, and trust it, and target 3-to-1 as our maximum on our average trade, if we can capture 50 to 80% of the move on our average trade, we're killing it. And by the way, nobody can consistently get the entire move. Can't happen. If anyone tells you they can do that, they're lying through their teeth. I'd love to be proven wrong on that, but it can't happen. But capturing a chunk of each and every move every day as a way to earn a primary or secondary source of that is feasible. So actually the problem becomes there are too many strategies. There are too many. So in order to narrow it down, I'm saying to you, either pick something with a really good win ratio like the head and shoulders pattern that wins 83 out of 100 trades, or try to find a strategy that is a 3-to-1 trend-based strategy. That's it. Go out there. You know that it's either going to be a breakout or an entry. So could I have got in on this one here potentially? Could I have got in? There's your pullback before the breakout. So that's a higher risk entry because you haven't got through here yet. There's a breakout. So you could have put an entry above that possibly. Where would you have put your stop loss? I'm so glad this chart is in front of me to illustrate this point exactly as we talk. I'm going to take my watch off, sorry. So when we clean this up, here is a level. We get a breakout candle. Before this happened, before that breakout happened, we knew that at some point price could potentially break out there. I want you to know that because we have higher lows going into it, this is a bullish setup. So when price is trying to break through a level to the upside, it'll tend to produce higher lows going into it, which is also, by the way, known as an ascending triangle or a descending triangle. Over here, here's our support resistance level. We've got a series of lower highs. So that's actually becoming bearish. Okay, look at this. This is a double bottom. There's your double bottom. This is actually a triple bottom on the daily. We'll go and have a look at that. Very straightforward things. That's actually arguably a double bottom. Double bottom in an uptrend, double tops in a downtrend, blah, blah, blah. It's beautiful. It's just, and I will say this, as you gain experience, once you've just done time, looking at the charts for, you can call it 10,000 hours if you want. You see everything just becomes the same thing. You see an uptrend, you see double bottoms, you see reversals. Your brain just sees everything like Neo in the Matrix, in the first Matrix movie, where it just becomes, you just see it all. And it becomes very easy to see it because your brain is not trying anymore. It has the references. It knows what a double bottom looks like on a top. And now it just sees the stuff. So it's not having to learn it. You're still learning, which is acceptable. So in this particular case, let's go back to this. We have this flat level. So I decide to get in on a breakout. Where do I put my stop loss? This is an important lesson, ladies and gentlemen. You can put your stop loss here, you put your stop loss here, you can put your stop loss here, you can put your stop loss there. All of those are valid. Every single one of those is a valid stop loss placement. So in other words, yeah, there are different places to put your stop loss. But the further out your stop loss, the further out your take profit. So our journey as a trader is to try to gain experience and a strategy and advice and a plan for where the best place is on average, on our average trade, to put our stop loss. And in this case, probably here. If maybe, and this is where psychology comes into it, maybe I've had a bad week. So I'm just like, I know I should put my stop loss there, but I'm a little bit twitchy, so I'll put my stop loss here. But then there's a point where actually, the further out your stop loss goes, the more you add risk back into the mix. Because if your stop loss is too far away and your take profit is too far away, you're giving the markets, how do I phrase this? Too much opportunity to stall, to just change its mind and change direction. So it's not a sliding scale. It's like a ramp. On the one side, it's higher risk. On the other side, it's higher risk. And in the middle, it's just the right amount of risk. Goldilocks approach. Again, here's a flat level and a breakout. There's a nice breakout there. And if you'd put your stop loss here, you'd probably still be protected even when it came back. Okay, here, flat level, breakout, stop loss there or there. It's fine. This is a very broad approach, but it works. Phenomenal book, this is reminding me of the phenomenal book, which doesn't even talk about this stuff, but it talks about this kind of thing. It's called Naked Forex. It's a guy called James, I forget his name. I think his surname is James. Anyway, it's called Naked Forex. Phenomenal book just on that. Takes these ideas, and then you've got a book it gives you ideas. But here's the thing, we want to talk about how price reacts at certain levels. So we can see when markets react like that, it's potentially likely to have a reversal. So if a market is trending up, so imagine I'm aiming for this level here, and the market's trending up and it's doing a little move, and then we see the market do this. So compared to the previous moves, this is ridiculous. It's very overextended. We've seen it on Bitcoin, we've seen it on Tesla, we're seeing it on Nvidia. It's a very much overextended burnout move. It's gone parabolic. This is a normal type of move, and this is an extremely abnormal move. So usually it'll hit a major level, and when it hits a major level like that, it's very overextended. It's absolutely exhausted. It's been running a marathon, an Ironman practically, and so it usually has a big correction. So if you then did get a very bearish reaction at that level, it makes complete sense. You're like, holy cow, it's very overextended. Every time I've ever seen this, it's always been, it's gone too far, it's overextended, overreached itself, it's well overbought. And so you see a big, strong bearish reaction at that. You put your entry, stop loss above the high, and you expect the market to come back. Now, you don't expect the market to necessarily come back to here. You know there's a very high probability it'll come back to here, slightly less higher probability to here, least highest probability it'll come back to here. So in other words, to predict where the market is immediately likely to go is a highest probability move. When you see a level breakout from here, it's probably going to do a 1-to-1. It's probably going to go up to the next major level, which is up here. So it should be able to reach that, the next level, when it's a breakout, because it's been locked up, it's cooped up, it's built up all this energy, and it breaks up. But you don't know it's going to go all the way to there. So traders are looking, again, this is why they do the 2-to-1s and 3-to-1s. They're like, listen, I know that it's most likely going to hit there. After that, I can either trail my stop loss or take partial profits, and I can do all kinds of things. So traders are not being ridiculous. Wherever gold is, whatever gold's doing 6 months from now, a year from now, I'll be trading that. If the gold is going down, if gold's down here, I'll be selling it. If it's going up here, I'll be buying it. Okay. So you need to learn to trust it. Now, on the 1 minute time frame, candles can be very different depending on, for everybody. There's no one in control of that. But as we get to the daily and especially the weeklies, they become almost universal no matter who your broker is, no matter who your exchange is, because it's such a big move. It might differ by a few pips here or there, and that's normal, especially with currencies. With currencies, there's no fixed exchange. So it's almost like I was going to say it's almost like a crypto network of multiple exchanges anyway, so everywhere. So everybody becomes part of the bigger exchange, the bigger web. But whereas things like stocks, it goes to a central exchange, therefore the closing price, open price, lows and highs should be fixed. Cool, so let's start doing some analysis of this, and let's go down. Let's start with gold because we have it in front of us. Let's go down to this. So the problem I have is we're right near a very strong level of resistance. Will we break out? At some point, it's not crazy to think we will. What would it look like if it gets up there? Well, first of all, we won't have a rejection like this. We won't, because actually this time round, people aren't exiting as much, and it'll look more bullish. So I would expect a bullish candle like this probably to start closing near the highs. Okay, and we'd have higher lows. Remember, higher lows potentially or equal lows going up into that. We'd see the buyers are in control. So then we'd expect price to do it. And then looking for a breakout candle would be good. Could it succeed? It could fail, usually within 3 candles. So breakout, next candle back, or breakout, a little bit of a stall, next candle back. Usually within 3 candles, it'll fail. But because the longer it's taken to build, it has a good chance of breaking out to that one. Especially if it slowly works its way up, it'll just break out. So we can see that. If it breaks these lows, it would be like this. Back then, by the way, before cryptos existed here, even existed, as the expression goes, before they were even a glint in their daddy's eye, people were going insane about gold and silver, the way they went about cryptos, about you better buy it now, panic, 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 panic. And then it just stalled, and then it stumbled for a bit, then it broke the low, and then it crashed, and it crashed in 2011, 2013, didn't even resurface again until 2019. So that can happen with anything, any market. We could go, it's feasible, it's not impossible. We could go into a stock market that goes into a sideways motion for 10 years. It's possible. Everything is possible. But we have to go again with what the market is doing now and what it's most likely to carry on doing. So let's quickly go down. Let's go down to the weekly. Let's have a look at gold. So you can see gold has done a bit of a double bottom here. It's beautiful. If I actually bring it down, this is where the double bottom is. Beautiful, beautiful, little bit of a dip below, double bottom together. Very nice. And I would say if it breaks this high, it's logical to assume it's going to go up to here. And if it breaks it here, it's very logical that it's going to creep up to that. Okay, so we've double bottomed here. We've got a good chance to run up to here. Good chance to run up to that one. So let's go down to the daily. So we look at the daily. Daily's come up, produced a little bit of this. Look at this, ladies and gentlemen. I love this stuff, man. There's your consolidation and your breakout. Let me just draw. Where's my shape? So there's my beautiful consolidation and my breakout. Lovely little consolidation breakout. So it's nice and bullish. I'm looking for this to continue up. Let's just say that I think it can work its way up to here. So I'm using what we call market structure to identify this. So we should, in theory, have some potential for this to go up. It's got a potential level here as well. I see that. Let's go in and mark this. So we've got a potential level where we are now. But I'm thinking in principle, we should be able to work our way up to here if we can break through. So let's go down to the 4 hour. We are a bit overextended. What do we have? wouldn't that be a potential for another little consolidation breakout? I think it's overextended. So I think it could come down a bit back into here and then carry on, or it could break through. So either of those are fair possibilities. Just make it a little bit lighter. Sorry, guys. Okay. Fair. So for me, I'm really looking for buying opportunities up to here. Now, I can't get in now. Why? Well, because we've got a level right here and we're in a consolidation. Could I potentially? And remember the idea. What is the idea? Well, we've got a double bottom. The double bottom is really where I believe we've got room to go higher. Plus the general bigger, much bigger view is to the upside. So I think we have a fair shot up here. Am I saying that's guaranteed? No, I'm saying it looks like the most probable direction gold is going to go in right now. So how would I get in? Well, consolidation here. So yes, possibly, and a level of support resistance here. So yes, I could potentially put my entry here and a stop loss here. I'm certainly going to make sure I take some profit ahead of this level. So that is a broad, very broad approach. It means I'm not paying attention. I leave the order, I go away, I either get triggered in or I don't. And I accept the possibility I could get a false breakout. I accept that. Now, alternatively, price pulls back to this level, and I might be able to get a pullback and even make some profit here before it even gets up to that level. That's a possibility. There might also be a breakout and a pullback here before it goes off. So I get an entry here, or even a break there. All of these are pullbacks and breakouts, and so traders are getting in on different time frames. We might be talking right now about the 4 hour, but there'll be traders who get in on all those other little entries on the 30, 15 minute, the 5 minute. Day traders are generally getting the 15 minute, 5 minutes, 1 minute. Let's observe this and go down to the 1 hour. So we can see what's happening here. It's trying, it really wants to, but it hasn't broken out yet. I'd be very cautious of that. We would go down to the 15 minutes. Look at that. When this breaks, when this moves, it's going to move, whether it's to the upside or the downside. And I would prefer to see it break above this level. Okay, so that's what I'm watching for. I'm principally bullish on gold. I can wait and see. It's not a problem. I could set an alert here and set an alert here. As soon as one of them triggers, I could come in and watch and wait for my entry. Okay, arguably, the first candle up could be I could wait for the first candle to break out and close. That gives me about a 4 hour window, give or take, at least up to a 4 hour window to decide if I even want to get in. So it's fine. And if it goes all the way up in one 4 hour window, nobody can predict that. And you're going to, yeah, you might have to miss it. You might have to get in on a lower time frame. Could it do that? It could, but it's not the most likely situation. You prepare. So with experience, you learn to, in your head, you learn to list about 10 different ways the market's likely to unfold, dismiss a big chunk of those, and narrow it down. Okay, so now that we've done that, let's go and have a look. One of the things I really like is we do have the dollar index here. So here's the dollar index. Let's open this up, put it on a chart, and let's talk about what's going on with the chart. So we'll create the template and we'll make it this one. Okay, let's do this one. So let's look at the dollar index at the moment. So the dollar index was in a downtrend. It's now starting to look less and less bearish. It's come back up here, so potentially up here. So the dollar index itself, which is the dollar's performance against the basket of major currencies, has been strong recently, has been. It's now hit a level of support and resistance and could potentially be battling with that level. All right, so let's go to the daily and have a look here. Okay, so here you can see that level of support and resistance. And if we've got a very bullish candle here, we could reasonably assume that it's going to attempt to work its way back up here. Okay, so the next thing I want you to think of is day traders are only operating within what's probably going to happen today. That's the healthiest mindset to have, is to go, what do I think is most likely going to happen today? So if we look at the 4 hour here, the problem we have is we're in a downtrend on that dollar index, potentially. And even here, we've got a little bit of a momentum candle to the downside, a little bit of consolidation here, momentum candle. We're probably going to come back down and test this level. So based off what I see of price action, the most likely thing is this is going to come back and tap this level again. If I saw this pattern 100 times, most of the time it would come down and at least tap this level, if not potentially come back down to this level. So that means that I could look for possible trading opportunities here. But overall, I'm not liking this. This is not my best, not my favorite setup. So let's leave the dollar index and let's go ahead and have a look. We've looked at gold. We've looked at gold. We can compare that. Let's go back and have a look at, say, silver to compare it. Very nice double bottom here. Beautiful double bottom here. Boom. Looks like it's heading up to here. And it kind of makes sense. I mean, it kind of makes sense that it's going to do that. Also had that beautiful consolidation and a move. So it's got some possible potential there to go a little bit higher. This is pulling back. Beautiful. Where could it pull back to? Could pull back to here. Very crisp little level. Very nice. I like that. I like that. If it potentially, excuse me, forms a bullish setup here, it might just take another run at that level. So ladies and gentlemen, when we trade price action, we have two things. We have price levels, market structure, price levels, and we have candlesticks, and we just don't overcomplicate it. Okay, I would say yes, I would say there's a level here, so I need to think about that. But again, if price breaks through here, it's probably going to keep going. Where's it going to go to? Probably up to about there. I should change the color of this. It's probably going to go up to there. So you're on the 4 hours, so when you go down to that 15 minutes, you can actually understand what you're trying to do. And again, I could adjust this. I could move it up and say, okay, there we go. There's my level. Let's actually leave it there. I like that. And do it. And you can see it's going through a bit of a sideways motion here. There's even a little bit of a flat level here. It breaks up. So we've got a couple of things. Potential to trade up to here. Certainly if we break up there and retest, we could be able to get up to there. It's had a very big move and it's basically tired. It's just recuperating. All right, let's go back and have a look at some of the other markets. Okay, so what's going on with some of the yen pairs? I've actually grouped everything here so that I can get a sense of what's going on. So if I go back up to the daily and I look at dollar yen, what's going on with dollar yen? Let's look at the weekly charts. They're generally trending higher. So that's dollar yen. Let's look at euro yen. Euro yen is looking very bullish. A little bit of a consolidation. Look at that candle trying to break through there to go higher. It's beautiful. Came back and retested this level. Broke through it, retested it, trying to go on now. It's trying to keep going. Let's look at pound yen. Pound yen is also trying to push higher. Aussie yen trying to push a little bit higher as well. And Aussie yen, at least you know it's got up here before, so you know it's got the potential to get up there again. Kiwi yen also got a similar type of setup. They're not as strong as pound yen and euro yen, but they're there. Swissy yen. Look at Swissy yen. This is ridiculous. Go down to the daily. You can see what happened. Bit of a consolidation here. Oops, I didn't mean to do that. Let's try again. Yeah, a little bit of that. So it's trying to get out of that range. They're all coming near all-time highs, and I would just be cautious. CAD yen. Oof, what's CAD yen doing? It's trying. It's potentially got this breakout happening here. So where could I get in on this if I thought it was going to succeed in the breakouts? Get in on the break above here. So probably an entry about here. Stop loss, I could put my stop loss here. Very feasible, very feasible. I could put it there, I could put it there. Definitely safe under those, or safest, or a little bit more bullish, a little bit more thing just under that little double bottom there. That's a little double bottom. Go to the 4 hourly, go to the 1 hourly. Let's have a look. You can see how price tapped there and went off. Okay, could put my stop loss there. Just like that, boom. Let's go up to the 4 hourly, go up to the daily. You could see, here's that little finish there. Anyway, oops, I moved it. Okay, so we've got a couple of things there. Let's have a broader look. Let's see. So now if we go to the indices, or actually very quickly, sorry, let's look at UK oil. Let's look at oil. So what's happening with crude oil? It's heading higher. Was in a bit of a downtrend, lower lows, low highs, low lows. We're about to break this high. If we look at it from a weekly perspective, it's got a significant level. Is it unreasonable to think it's going to break high? And yeah, look at this. Wasn't a downtrend, double bottomed here, tried to come down again, produced all these very bullish wicks. Let's push it back up. It's at this level, pull back, trying to head up here. Looking bullish, wants to break out and go up. Look at it from a monthly perspective. Also found support here pushing higher. So if we look at it from a daily perspective, we know where it's going. It's looking nice and bullish here as well. Then, so we know crude oils are looking somewhat bullish. Let's now go look at the Dow. So what's going on with the Dow? Let's clean this up. Look at it from a weekly perspective. Put in your support resistance levels. If you're not sure, if you're like, well, does it go there or does it go there? Well, it's okay. This is it's up to you. You put the level in where it makes the most sense to you. That's okay. And there's no such thing as, well, if I show it to 10 really good traders, they're all going to agree. They won't. They'll all have their levels in slightly different places. Some people don't even use horizontal levels. They'll use trend lines. But actually, horizontal levels are eternal. They will stay here forever, and they will always impact price at those levels. Trend lines come and go. So horizontal levels are the single most important level. Identify market structure. So you can see a couple of things where you go, okay, well, I think, I want to count one here as an example. But yeah, we have an uptrend. We have a low and a high, series of higher lows. There's your swing low, got a high there. It's in an uptrend. So it is in an uptrend on the weekly. We've got a daily that's trying to push a little bit higher. Let's look at the 4 hourly. The 4 hourly has just broken through this level. Beautiful little bit of a consolidation, and there's your momentum candle, your breakout candle. So it's kind of where it is at the moment. At the moment, it's trying to decide what to do next. But make no mistake, it's gone from a long-term downtrend it's now into an uptrend, breaking these highs, high lows, higher highs. So we've got the Dow pushing higher. What about the S&P? Weekly is the same. Beautiful double bottom here, really nice. Price pulls back to the level, double bottoms, pushing up. So we know it's going to go up to here. Highest probability move is up to these old highs. Why? Because it double bottomed on the way up. And sometimes if you don't see this, that's okay. It takes time. Once you start, now that you know what to look for, your eye can master finding them. If you're jumping between things, you can't really get it. So we can see here, we've got an uptrend. We've gone from this low to this high, to this higher low, to this high. It's looking good. We know that it's probably going to head up to here. So we go down to the 4 hour. So now all I'm really looking for are potential entry points into this. Price can pull back to these levels, could pull back to here, could. Generally, try to simplify. Don't overcomplicate it. And by the way, where you place your support resistance levels is just something. It's an ongoing thing you will always do. It's the one thing that you're just sharpening the saw. You're always doing it. Okay. And there are certain things that traders are continually evolving in, and other areas where they don't even need to evolve because there isn't room for evolving. We've got a potential level over here. Let's put that there. We touch the top of that. We're here. Should price break up here, retest and go. In principle, put my stop loss there or wherever the nearest swing low is, do that kind of stuff. Okay, so we are bullish in the markets. The most important one is the weekly. Why? Because we could see the weekly chart has gone higher. Let's change it. Change the color so we can see. I wanted you to see the shapes. The colors is an extra layer. It's an extra layer of information. If it's green or red, it's extra layer. So let's do that. So we know the Dow is bullish, the S&P is bullish, the NASDAQ weekly is also bullish here. Look at it, breaking the high, so that's bullish. It means it's probably going up. Looks nice and calm. It's not erratic. It's mostly looking very good. Let's look at a few others. What about the FTSE in the UK? FTSE here has bounced off the top. We do have lower highs. We do have that. So if we produce another low and we start coming down here, yeah, then we could see us breaking through. But we're not there yet. It can go through a whole lot of a mess before it breaks out. So here, it's crucial because if it breaks above this high, then it's produced a fresh high. It's unlikely to come back down here. So this is important. Up to there, probably high probability move. Then when it gets here, I want to see if it breaks above or rejects it and comes back down or produces a lower high, comes down. But the DAX. DAX is stuck within range near its all-time highs. So the FTSE is near all-time highs, DAX is near its all-time highs. The NASDAQ, all these different things are going to all-time highs. So disregard the media. The charts is telling you where the actual orders are going through. A month from now, then the media will start saying, oh yeah, the markets have recovered somehow. This is how they've recovered. Don't worry about it. The price will tell you what's happening. If you ever, one of the biggest, most important pieces of advice I can ever give, if you ever have to choose between what the chart is doing and what you're hearing in the media, you always go with the chart because of the physical orders going through. So notice the smart money is the stuff that's actually in the market. And I think on another level, you know this. You know that the smart money is already in the market. It's getting in early, it's getting out early, it's doing all kinds of things. So what you see in the charts is what are the physical orders going through, and you need to follow that. Let's have a very quick look at a few of these companies. We've got 1 minute. What's going on with Apple? Apple's come back to these levels, looks nice and bullish, looks very good. Had a nice little correction into all-time highs, good. What about Disney? What is this pattern here? This is something to be alarmed about. Disney is coming right into these lows. It's come back to its 2014, 2013 values, and it's producing a series of lower highs. Could it break out and drop? It could. All right, could it reverse from here? It could, but this is its last stop. All right, it looks like it's going to potentially do a false breakout, possibly. It's broken through that level. If the next one goes back up, it's a false breakout. But if it doesn't, if it keeps going, then Disney, then Disney's in dire straits. Okay, despite the fact that they've got so much good content, they clearly have not been thriving, and maybe the streaming wars are an issue for them. Here you've got the 50, 20, and 10 and price. Here you're underneath that. We haven't been in this kind of situation in many years. So right now, Disney is looking incredibly weak. And a few others. What about Tesla? And then we'll wrap up. Tesla is currently in an uptrend, producing high lows. And this, by the way, this isn't really about whether we love or hate Elon Musk or anything like that. This is just what is Tesla doing. It's currently in an uptrend, trying to work its way back up to these highs. You can see what it's trying to do. Then we look, and what was the last one? MasterCard has, no, that's McDonald's. Here's MasterCard has gone to all-time highs, looking very bullish. MasterCard is insanely busy, daily, weekly, hourly, crazy, man. Yeah, was that it? Was there anything else I wanted to add in? I'm fine with it. So, ladies and gents, let's go back to this. Today, we covered why we trade with the trend. We covered that if we're looking for a trend, then it just becomes about whichever market has got, whichever instrument has a good trend. We've covered why we should have faith in price action over anything else. Why we should keep it simple. Why we should use stop losses, where we should put our stop losses, why we should take profit, and allow the numbers to take control. Okay, it's very wax on, wax off. But if I'm mentoring someone, I'll get them to do something very simple for like 50 trades or 20 trades, and watch how many things fall into place. Suddenly they realize why they mustn't mess with the system, why they must be consistent with their behavior, why they must put their stop loss in certain places, why they must take profit. So it is a wax on, wax off moment that when you pick one strategy and stick with it for 50 to 100 trades, you very quickly master a lot of things because now you're focused. So now when you're focused, you know what to look for and your brain knows what to start observing. So those are the things. I hope that you found this constructive and useful. I could talk about it forever, but I've got to call it quits for today. There are plenty of opportunities in the market. We are in a bull market, despite what you hear in the media. Always trust the charts over it. Don't let the paranoid and all the ridiculous stuff get in your head, because that's not what Warren Buffett does. Okay, and that's investing as well as trading. All right, remember, trading is practical, shorter term, highest probability. What is the market most likely to do next? And cover my ass with risk and stop loss just in case it doesn't. So on that note, ladies and gentlemen, I hope that you found this instructive and useful. If you have any questions to do with your account or the platform, I highly recommend you get in touch with the lovely folks at Vantage Markets. You've got all their contact details here. Use the one that you are most comfortable with.